Welcome to Simple Investing Secrets, your trusted source for valuable investment insights, stock recommendations, and strategies to help you achieve financial freedom. In today's video, we'll delve into Jim Rickards' caution about potential bank collapses and highlight the crucial asset for ensuring financial safety. So before we start, if you find value in this video, please support our channel by liking and subscribing to our weekly updates. Now, let's get started. Analyzing recent developments and closely monitoring the condition of financial institutions, loans, and mortgages unveils a noticeable shift in the financial landscape of the United States. A growing sense of panic is taking hold, and the impending consequences remain uncertain. This video aims to explore the emerging financial panic, shedding light on its root causes and providing insights into mitigating the impending crisis. The tangible effects of the ongoing economic downturn are evident, marked by an increase in business closures, rising unemployment rates, and a contraction in the gross domestic product. While the collective aspiration for an economic upturn is widespread, it is crucial to recognize that recessions are inherent components of the business cycle. The duration of recessions exhibits variability, and over the last 2 decades, the United States has experienced economic contractions in 2000, 2007, and 2020. Notably, these cycles appear to recur approximately every 7 years. However, the current recession spanning from 2020 to 2023 deviates from the anticipated 7-year interval. The inherent unpredictability of the financial realm adds a layer of complexity to comprehending the current economic landscape. Having witnessed consecutive recessions in 1980 and 1981, there is a prevailing sentiment among analysts that the impending economic downturn may surpass initial expectations. Projections suggest a potential downturn of up to 30%, and in more severe scenarios, a staggering 50%, with the S&P index potentially reaching as low as 22,100. While a brief respite occurred between the recessions of 2020 and 2023, the looming threat of a financial crisis casts a shadow over the economic landscape. The brewing financial crisis has already instigated panic, and the potential repercussions could lead to a bleak day for both America and the global economy. It's crucial to recognize that each financial crisis carries its unique impact, varying from substantial to more moderate losses. According to Jim Rickards, accurately predicting the scale and duration of a crisis requires assistance. Occasionally, a financial crisis coincides with a recession, amplifying its detrimental effects. A prime example of this occurred during the subprime mortgage crisis from 2007 to 2008. The expansion of mortgage credit, facilitating easy borrowing and mortgage acquisition, resulted in a catastrophic burst of the housing bubble in the U.S. The repercussions extended beyond American borders, affecting global trade and causing widespread losses in homes, savings, and employment. While discussions surrounding recession, inflation, and deflation have been prominent, an impending global liquidity crisis has yet to be thoroughly explored. Notably, historical instances like the close call in 1998, where the financial world teetered on the brink despite the absence of a recession, and the synchronicity of recession and crisis in 2008 serve as cautionary tales. The latter event witnessed a worldwide collapse in industrial production, frozen credit markets, and plummeting commodity prices, resulting in a staggering $2 trillion loss in global economic growth. Drawing parallels to the Great Depression of 1931 to 1933, characterized by multiple bank failures, currency devaluation, and a general cessation of world trade, Jim Rickards warns of a potential repetition of history. The signs, as per financial experts, are already emerging, raising concerns of a financial crisis coinciding with a recession akin to the 2007 to 2008 collision. The indicators are multifaceted, encompassing a decline in world trade predicted by the World Trade Organization for 2023, a daily reduction in industrial output coupled with a growing unemployment rate. Additionally, the highest interest rates in American history, currently at their peak in 15 years, indicate the federal government's attempt to curb inflation. Paradoxically, the inflated prices of goods and services persist, exerting a draining effect on salaries and wages. The emergence of inflation became pronounced around mid-2021, gaining momentum through the summer and reaching elevated levels by the fall. During this period, Federal Reserve Chair Jerome Powell repeatedly characterized it as transitory. However, by November 2021, Powell abandoned this term, acknowledging the persistent nature of inflation. Subsequently, in March, the Federal Reserve initiated rate hikes, marking a stark shift from the zero policy rate on March 1st to the current 4.25%, with an additional 50 basis points expected on December 14th. To further underscore the gravity of the situation, recent events in the American banking sector paint a concerning picture. Within a month, 5 major banks have faced dire consequences. Silvergate Bank, valued at over $5 billion in 2022, declared bankruptcy on March 8th, 2023. Silicon Valley Bank followed suit on March 10th, succumbing to a financial crisis rooted in mismanagement and subsequently being taken over by the FDIC. Signature Bank experienced a similar fate on March 12th, falling victim to a bank run triggered by the failure of Silicon Valley Bank. First Republic Bank narrowly avoided collapse on March 16th, as 11 banks intervened to address a $30 billion liquidity crisis after losing approximately $70 billion in deposits. Lastly, Credit Suisse, a global banking giant and Switzerland's second-largest bank, collapsed in March 2023 and was acquired by rival bank UBS for $3 billion. Remarkably, all 5 bank failures transpired within the span of a single month, further underscoring the severity of the economic challenges at hand. As per Jim Rickards, the cumulative losses incurred by credit and stockholders across these financial institutions amount to over $200 billion, signifying a substantial financial setback. The repercussions of these bank failures have triggered widespread public concern, fostering a sense of panic. In an attempt to allay fears and assure the safety of deposits, the FDIC has taken unconventional measures to regulate these banks. Typically, the FDIC provides a maximum deposit insurance limit of $250,000. However, in response to the March 2023 bank failures, the FDIC has guaranteed an insurance deposit exceeding $200 billion for all depositors of Silicon Valley Bank and Signature Bank. This unprecedented move, while appearing reassuring at the moment, raises concerns about depleting the FDIC insurance fund. Jim Rickards anticipates that ultimately, the burden of such actions will fall on consumers and individuals at the lower rungs of the economic hierarchy. Adding to the complexity, the Federal Reserve has extended an offer to provide additional loans to member banks through the Bank Term Funding Program, or BTFP. Jim suggests that the total cash volume for these loans could surpass $1 trillion. These unconventional measures have stirred significant disruption within the U.S. banking system, leaving everyone, especially depositors, in a state of confusion. The motivations behind these rule-breaking moves, whether driven by a shift in policy or influenced by the repercussions faced by influential figures connected to the affected banks, remain uncertain. The FDIC, alongside Shilbear and other entities, took an unprecedented step by guaranteeing every bank deposit in America, surpassing the usual $250,000 insurance limit. This move was prompted by the fear that small businesses, with deposits potentially exceeding $1 million, would withdraw funds, creating a potential financial upheaval. A similar situation unfolded in 2008, when then Fed Chair Ben Bernanke opted to guarantee all deposits in response to escalating concerns during the financial crisis. Personal experiences, such as the urgency to withdraw funds from banks like RBS, underscored the severity of the situation. However, current circumstances raise questions about the U.S. government's response to unrealized losses exceeding $700 billion in U.S. bank portfolios. The worry is that continuing to provide cash to depositors fleeing the system might lead to its collapse. While these measures aim to reassure the public about the safety and security of the banking system, doubts linger about the true state of affairs. The critical question remains, is the crisis truly over, and have these assurances effectively quelled concerns? The answer, as indicated, is negative. The panic is just beginning. Drawing parallels to the 2008 financial crisis discussed earlier, which bears resemblance to the events of 2023, it's essential to note that the 2008 crisis began in the spring of 2007. The revelation by HSBC that mortgage losses exceeded expectations triggered a significant panic, setting off a chain reaction of events leading to the financial crisis. Key occurrences during that period included the failures of institutions like Bear Stearns in March 2008, Fannie Mae and Freddie Mac in June 2008, the closure of the General Money Market Fund, and the downfall of several other institutions. The 2008 financial crisis reached a critical stage in September when Lehman Brothers, considered a major player at the time, filed for bankruptcy. Drawing a parallel to the present, the current crisis, though only a month old, has already led to the downfall of 5 banks. This pattern is highly indicative of the broader economic landscape, signifying a pervasive and systemic issue. The Federal Reserve's intervention to guarantee all depositors, while addressing an immediate concern, reflects a commonality in the financial sector. This situation is not isolated. It permeates the entire economic structure. The core issue lies in the substantial creation of debt for investment purposes. What heightens the concern is that this is merely the inception, and there is potential for the situation to rapidly deteriorate. Jim Rickards posits that contemporary technology could exacerbate the crisis at an accelerated pace. The ease afforded by technology, particularly in the realm of finance, can rapidly amplify the impact of a crisis. In the event of a bank collapse, the instantaneous instantaneous nature of technological transactions allows customers to swiftly transfer funds to a secure account using their phones. This contrasts starkly with traditional scenarios where one needed to physically visit a bank for withdrawals. Whether the sum involved is $1 or $1 million, the ease of moving funds with a few clicks amplifies the potential for customers to prompt rapid bank runs, creating a dynamic shift in the financial landscape. Before we delve further into our discussion, if you're finding value in this video, please hit the like button. Don't forget to subscribe and ring the notification bell to stay informed about our upcoming content. Now let's resume. Jim Rickards underscores that the current financial panic is likely to escalate faster this time due to the collective memory of similar events, particularly the 2008 crisis. Savvy individuals have proactively safeguarded their assets, reflecting a diminished confidence in the government's ability to restore normalcy. Notably, the crisis is transitioning from the banking system to the very foundation of the financial structure. The dollar itself, the US dollar being the world's reserve currency, holds a pivotal role. The potential failure of this reserve currency could unleash a global financial tempest. Observing the news reveals a trend wherein many countries are actively seeking alternatives to the dollar. China is positioning the yuan as a viable alternative in global trade, while Russia has already embraced international trade using the Chinese yuan. Other nations, including Saudi Arabia, Brazil, and Iran, have opted to trade without reliance on the dollar. This shift prompts speculation about a gradual erosion of confidence in the American government. The financial landscape is witnessing a loss of confidence, not just among bankers in the Federal Reserve, but also among nations growing impatient. The anticipated outcome involves not only the collapse of banks, but also the potential collapse of the dollar. Forecasts suggest more bank failures in the coming months, and Jim Rickards predicts that the U.S. Treasury will soon exhaust its cash reserves, necessitating additional borrowing. In summary, the unfolding financial panic is in its early stages and is expected to intensify in the foreseeable future. A financial upheaval is looming over America, and it won't stop at bank runs. A debt crisis is imminent. As discussed, government interventions to quell the panic may inadvertently expedite the breakdown of the financial system. Given this scenario, what proactive measures should one take to safeguard against the impending crisis? Jim Rickards advocates for the primary step, acquiring gold. Gold, often seen as a reliable hedge, is poised to weather the storm, a sentiment even acknowledged by the government. A recent tweet from Jim Rickards highlighted that members of the U.S. Congress introduced the Gold Standard Restoration Act, proposing to peg the U.S. dollar to a specified weight of gold. This development serves as both a powerful signal and a wake-up call. To secure oneself in the face of the impending crisis, investing in gold is strongly recommended. Options include gold bullion, gold mutual funds, or gold ETFs. However, Jim Rickards emphatically asserts that gold bullion is the superior choice. For those unfamiliar with the term, gold bullion refers to gold bars or coins. Obtaining gold bullion can be done through reputable online dealers or local collectors. It's imperative to conduct thorough research when engaging with online dealers to avoid potential scams. As the storm approaches, taking these steps can help preserve wealth and navigate the uncertain financial landscape. If you found this information valuable, please show your support by liking this video and subscribing for our weekly updates. Your path to informed and strategic investing starts with simple investing secrets.